In our rapidly changing world, we see economies investing vast sums each year in services that don't directly enhance our daily lives or prosperity. They mainly serve to delay inevitable challenges. The true path to economic prosperity lies in infrastructure investment. Nations with robust infrastructure tend to thrive, while those lacking it face hurdles. However, there's a crucial trade-off here, and even the brightest minds in economics, policy, and engineering are still grappling with a definitive answer. Yet, there's a dedicated community working towards a solution. If they succeed, they could potentially double the wealth of the global economy in under a decade, perhaps becoming the wealthiest individuals or groups in history in the process. It's important to note that the world's largest and most profitable companies owe their existence to investments in universally accessible goods and services. These range from tangible essentials like roads and ports to less apparent but equally vital components like education and defense. Governments worldwide have embraced this advice, and infrastructure development has become a focal point for policymakers. Entire nations have structured their economies around these essential projects. For example, in the USA, the New Deal, an ambitious infrastructure spending initiative, played a pivotal role in reviving the economy during the aftermath of the Great Depression. Today, post-COVID, the Build Back Better plan carries the torch. It's not unique to the USA either. Many of the most significant economic success stories of the last century began with, or were greatly boosted by, substantial and well-planned infrastructure investments. Typically, such projects are funded by taxpayers through government spending. In some rare instances, particularly in resource-rich nations, alternative state revenues may foot the bill, and in a few cases these services are entirely privatized. Each funding method has its own set of advantages and disadvantages. However, regardless of how they are funded, one universal challenge shows large: maintenance. Maintaining infrastructure might not sound as exciting as other aspects of economics, but in reality, it could be the most critical challenge in macroeconomics. It has the power to explain the success or failure of economies worldwide. And we're not the only ones who think so. Adam Smith, the founding father of economics, devoted a significant portion of his influential work, The Wealth of Nations, to discuss the significance of infrastructure in building prosperous nations. While governments often notice the first part of Smith's advice, which highlights the advantages of nation building, they sometimes overlook the warning that, like everything in economics, infrastructure has its own opportunity costs. When managed poorly, it can be as detrimental to an economy as it can be beneficial. So does infrastructure spending have a direct impact on a nation's economic prosperity? Can we address this challenge? And if not, what are the implications for economies worldwide today? In the context of economics, infrastructure refers to anything that eases the production of goods and services. Typically, economists use this term for physical structures like bridges, roads, and power grids. However, in reality, we often employ the term more broadly to encompass anything that we establish today to enhance future prosperity. This includes financial infrastructure, policy infrastructure, legal infrastructure, and more. Even though they might not neatly fit into the traditional definition, in any industry, some level of infrastructure is essential for competitiveness. Even in service-based sectors like banking, there's a reliance on internet and electronic infrastructure. Expanding the definition, they also benefit from national defense and education. While companies theoretically could provide these services on their own, the upfront cost would be astronomical, making them more competitive when these services are shared. In this scenario, companies like Amazon benefit from various public services or privatized services. For instance, Amazon's delivery van travels on public roads, protected by law enforcement, while customers place orders using internet services, which may also be publicly provided or offered by other companies. Amazon is a giant in the business world, but even this corporate behemoth relies on a vast infrastructure network that extends beyond its internal capabilities. It becomes evident that infrastructure spending is a sound investment because industries like Amazon, whether directly or indirectly, contribute to tax revenue, which can, in turn, fund more infrastructure projects. Additionally, infrastructure development serves as a significant source of employment and independently enhances economic output. This makes infrastructure spending a trusted tool for governments looking to revitalize their economy, especially after a slowdown or to create a facade of economic strength. However, it's essential to note that this approach only yields benefits when there's a genuine demand for the infrastructure tools being supplied. Sri Lanka has recently been facing a significant and ongoing economic crisis, a stark contrast to the apparent economic miracle it enjoyed for several years. Between the mid-2000s and mid-2010s, the nation experienced rapid economic growth, propelling it into the ranks of the fastest developing economies in a region characterized by rapid economic advancement. However, the true story behind this success was that Sri Lanka was accumulating substantial debt to fund extensive infrastructure projects. Now, in itself, investing in infrastructure isn't an issue. To become globally competitive, a country needs essential components like roads, ports, and electrical grids to support modern industries. Over the long term, this infrastructure can fuel stable economic growth. However, in Sri Lanka's case, the country became hooked on the short-term rush of growth that came with each new infrastructure project. When a nation builds a bridge, it generates employment for thousands of people, from engineers and laborers to local business owners, hiring extra staff to cater to the increased workforce around the construction site. The construction of a bridge contributes to economic output, which is precisely what it should do, and bolsters the country's GDP. A country can indeed borrow substantial sums of money to invest in infrastructure, a move that generates employment and makes the economy appear to be on a growth trajectory. However, once the construction phase is over, the employment boost recedes, and the economic growth for that year may seem like an anomaly unless the economy compensates by producing more to offset the absence of, say, a newly constructed bridge. One solution, although not always the right one, is to continue building. Economists typically are supportive of developing nations focusing on infrastructure development, making it relatively easy for these countries to secure loans for such projects. Additionally, countries might find comfort in the idea that if they struggle to repay their debt, they can privatize portions of their infrastructure, sometimes generating more revenue than the infrastructure originally cost to build. For example, if a country like Sri Lanka borrows $10 billion to establish an electrical grid, it would provide a $10 billion boost to its GDP, create jobs, and deliver electricity to homes and businesses across the nation, further increasing economic output. This accessible electricity could empower a Sri Lankan student to lay the foundation for a multi-billion-dollar company, offering opportunities that would remain unattainable without reliable power. In the short term, this electrical grid offers immediate advantages. Factories looking to leverage lower labor costs in Sri Lanka can now operate without the need to provide their own power generators, making them significantly more competitive. But it's not just in the immediate sense that this infrastructure investment shines. The $10 billion spent by the Sri Lankan government in our example isn't squandered. In many cases, the true value of an electrical grid, like this one, can far exceed its initial cost because private companies may seek to purchase it to profit from the growing demand for electricity in the country. For our example, let's assume it's worth $15 billion if sold to an international utilities company. This action augments what economists refer to as the capital stock. Ideally, this value surpasses the amount borrowed to fund these investments. It's a win-win scenario. The nation has the potential to profit while substantially boosting GDP and employment in the short term, with consistent long-term benefits. It's no wonder countries are motivated to continue this path. The challenge lies in the fact that not every infrastructure project delivers as much benefit. Sri Lanka found itself in a situation where it started constructing projects it didn't necessarily need, primarily to keep the construction industry afloat and maintain employment. To draw a rather fitting analogy, it's akin to a patient receiving medications from a doctor. When taken in the right doses, these medications can significantly improve the person's health and speed up their recovery. However, it's easy to become reliant on these boosts, potentially compromising long-term well-being. There's a prevalent assumption that public goods, such as infrastructure, don't need to generate traditional profits because they serve the public. While it's true They don't need to yield profits in the conventional sense. It's crucial that substantial projects like these eventually provide more value than they consume. Sri Lanka, being a lower-income developing economy, is seen as riskier by lenders compared to a country like the United States. Consequently, they demand higher interest rates. While following their initial success with the electrical grid, Sri Lanka embarks on a stadium project costing $10 billion. Generating a return on investment could be more challenging. Although it would contribute to GDP and employment, the long-term revenue from ticket sales and events may struggle to cover the interest on the loans used to finance it. As the government continues with multiple such projects, they might run into substantial issues repaying their loans. If this situation coincides with a major economic shock, such as a global pandemic or political instability, the government will face an urgent need for funds. Privatizing industries could be an option, but in dire circumstances, even major companies that were once enthusiastic about investing in an up-and-coming country may become hesitant to invest in a nation grappling with high unemployment and loan repayment challenges. Double-digit annual economic growth can indeed be a powerful force, especially in a country where it has the potential to lift millions out of poverty. However, if it isn't managed sustainably, it can ultimately leave the economy in a worse state than when it initially began. So far, we've been discussing Sri Lanka as a real-world example of the consequences of excessive infrastructure spending. However, this pattern isn't unique to Sri Lanka. It's a recurring issue worldwide. In fact, it might be occurring on an even larger scale in the world's second-largest economy, China. China has sustained some of the most remarkable economic growth in history, with infrastructure spending playing a substantial role. Due to its vast population, favorable geography, and historically lax industrial regulations, infrastructure limitations had, for a time, restricted the country's industrial capacity. Although these constraints have lessened over time, the Chinese government had grown accustomed to the consistently massive economic growth they were achieving. As always, it's important to note that economic statistics from China are known for their unreliability. Even figures that are viewed with skepticism are now indicating a concerning trend. The government-run corporations, and private households in China have all accumulated substantial debt to fuel an infrastructure development bubble that appears increasingly unstable. In China, various levels of government have gone to great lengths, developing entire cities with the belief that the country's urbanizing population would eventually occupy them. Given that all land in China is owned by the national government and can't be purchased, it has been a lucrative practice to lease these land parcels to developers for 99 years. This approach had its benefits. Local governments profited from the infrastructure spending needed to connect these new developments to basic utilities, and developers thrived by selling high-priced apartments to the public. Homeowners, in turn, benefited from owning properties that consistently appreciated in value, partly due to the nation's economic growth. Unfortunately, it was this very system that had been the primary driver of China's remarkable economic expansion. However, as China's population began to shrink, it became evident that there were only so many homes people needed. In all fairness, China maintained robust export-focused and domestic industries that supported this system for quite some time. However, this only prolonged the inevitable. Investment into extensive infrastructure like this came at the cost of investment in industries that could have genuinely enhanced the country's long-term economic capacity. In fact, setting up numerous scattered cities across the country often drew people away from the productive industrial centers along the coast. This debt-fueled spending certainly led to increased output while it was happening and contributed to growing China's capital stock. However, it filled that capital stock with things that weren't genuinely necessary. A prime example of this is the once extensive high-speed rail network, which eventually ran out of major cities to connect, leading to connections in regions that couldn't justify the traffic levels necessary for high-speed rail to remain economically viable. To complicate matters further, simultaneous development of the country's airports and local airlines often made flying between remote locations both cheaper and faster. This serves as a stark example of overdevelopment aimed at sustaining economic growth and appeasing various groups within the country. and it's far from being the sole instance. Now, the reason many major projects in advanced economies worldwide often stall is due to the presence of organizations that conduct feasibility studies. These studies aim to ensure resources aren't squandered on infrastructure or projects that won't yield a satisfactory economic return. As a country reaches a certain level of development, most projects may not offer substantial additional value. And in wealthier, more developed nations, they also tend to be costlier to construct, which further impacts the cost-benefit analysis that economists are tasked with performing. With so much money at stake, in the rare instances where exploratory planning and commissions identify a project that could work, and assuming it manages to navigate the various bureaucratic hurdles that government projects must clear, there's often a temptation to keep that plan on standby, ready to be deployed as a stimulus measure during economic downturns. It's a tactic that's sometimes seen as a safety net to provide a boost to the economy when needed. Stocking a country's capital with an excess of unneeded infrastructure is a misallocation of resources and is bound to create substantial debt issues, especially if the country relies on loans to finance these projects. However, this isn't even the most pressing concern. Up until now, we've been operating under the assumption that all of this infrastructure lasts indefinitely. And even if it doesn't deliver value, it shouldn't harm the economy beyond the interest on the debt that the country must repay. However, what often goes unnoticed are the ongoing maintenance costs. Factors like wear and tear, corrosion, damage from extreme weather events, and simple obsolescence don't factor into most headline economic indicators people typically monitor, such as GDP. Nevertheless, they gradually chip away at the capital pool each year, at a rate that can quickly account for a significant portion of the overall economic output. Corrosion, predominantly rust on steel infrastructure, exacts a staggering toll on the global economy, costing approximately $3.5 trillion annually, which equates to about 3.5% of global GDP. To put this in perspective, that figure surpasses the GDP of all but the 5 largest economies in the world. In simpler terms, even if the entire country of India dedicated its entire economic output to combating rust, it would still fall short of addressing all the damage this problem causes, silently and gradually, from the moment these new projects are completed. But rust is merely one facet of infrastructure maintenance. When you consider the collective resources dedicated globally to sustaining the infrastructure that already exists, this amount could conservatively be 6 to 7% of global GDP. This isn't just a marginal concern, it's a monumental issue. If, somehow, this problem were resolved tomorrow through a revolutionary new building technology, it would have a more significant impact on the world than even the internet or the steam engine. As we know, annual growth compounds, and if we could prevent this consistent loss of value each year, our capital stock would expand much more rapidly than it currently does, even with ambitious and perhaps even daring investments. If, for example, we had discovered a technology to eliminate this waste at the start of the new millennium just 23 years ago, the world would be 3 times wealthier than it stands today. Admittedly, it's a significant if, and we reside in a challenging world that takes its toll on the structures we construct. So, until we stumble upon a miraculous solution, the best we can strive for is to ensure that what we build contributes to this ongoing race against slow decay rather than exacerbates it. I appreciate your viewership. Thanks for tuning in, mate. Goodbye.